Thanks for tuning into Talking Point. I'm your host, Neeraj Shah. Our guest's last strategy note suggests that the risk on is waning as expectations reposition. Let's get him in on the show to talk about multiple talking points. I think we now know the usual conversation that we're having with people, and that's what we'll do with Dhananjay Sinha as well today. Bond yields continue to inch higher in the US. How will it impact equities in the US and India? What about India's macroeconomic indicators and what do they suggest about the state of economy and the impact on markets thereof? Are there sectors though which could outperform over the medium term? And is it time is ripe to bet on new age themes as valuations have corrected quite significantly? He joins in right now on the show. Dhananjay, good having you. Thanks for joining.
Thank you very much for having me.
So, Dhananjay, uh, the, the, is it going to be very difficult to make money in equities as the inflation expectations stay higher, yields stay higher, and growth falters?
Neeraj, you're not very audible actually. It's breaking.
Can you hear me, Dhananjay?
Yeah, it's better. Yeah.
Okay. I was asking you about whether it's going to be difficult to make money in equities.
Yeah, so the thing is, what we have seen over the last 1 year, I would say since the time I've turned a little conservative, that was, I think, around mid of 2021, the Nifty was 17,500. I think it is still the same. So if you look at last 1.5 years, the return on the index has actually barely managed to sort of outcompete the 10-year GSEC yield. So, 10-year GSEC yield may be about seven quarter, 1.5 years back. It's still the same. So I think the equity market as an index is actually underperformed. And going forward, I would say that what is important to really look at is what would be the earnings trajectory. And there we are seeing that if you look at the result analysis that we've actually presented in our report, basically says that over the last 3 quarters there has been a contraction in the net profit. If you look at the non-finance sector, which includes manufacturing and a whole host of service sectors, so we looked at a constant set of companies, roughly about 2,500 companies across sectors. So we see that there is a sort of a contraction. So that's earning part of it, and whether that sort of improves or not, that will become an important thing. We have seen sort of considerable correction in expected profits across most sectors, especially the cyclical sectors. And I think the upgrades have come from few sectors such as banking and NBFC banking sector in particular, and
Hmm.
consumer companies. But generally, there has been a significant downgrade. I would say that non-finance companies have been downgraded. If you look at the Nifty set of companies last year, let's say February 2022, and if I compare that in the current context, the earnings have been downgraded as an aggregate about 16%. For non-finance companies, banks have actually seen an upgrade of about 9% or so. So overall, there has been a downgrade of about 10%. Now, what has held up the market, I would say, even if it is actually flat over the last 1.5 years, is the fact that your valuations have gone up, notwithstanding the fact that the risk-free rates have gone up, and globally there has been hardening trend. In India also there has been a hardening trend. So I think since the mid of 2020, 2022, I think there has been a rebound on expectations that global rates will actually be cut. I think that hypothesis is changing. So you have a combination of earnings, which is actually modest, possibly further cuts will happen, and you will have valuations which will not expand. So I think it's quite likely that you will have another year where the index might actually underperform the GSEC yield. The GSEC 10-year is currently about 740 or 750 range kind of. So I think that's the broader context of the market.
Wow. Dhananjay, in such a scenario, would you position your portfolios much more towards fixed income as opposed to equities? Because, or you would believe that at some point of time the markets will start discounting 2024, and therefore let's stick to equities.
So I would say that it's all a function of how the market behaves. So if you look at how the market basically considers, just a sec. So if you look at the way market behaves, essentially they look at the momentum, and essentially the extent of forward-looking horizon that the market looks at is basically it's a function of how the momentum is. So if the momentum is positive, generally people tend to look at long end or a far end kind of a horizon. And if the market is volatile, the market psychology becomes more myopic, so they look at the near term performance, etc. So I would say that if I look at that, I would say that the actual scenario will be somewhere in between. The key thing to really look at is whether you have further devaluation as far as the valuation that the market gives, because the risk-free rate can actually rise, and this whole hypothesis that Fed would cut rates essentially is unwinding, and we are seeing that core inflation sticky all over the place. So your risk-free rate aren't going to come down. The focus will be more on earnings. As a result of that, I would say that people will be very sensitive towards how earnings are panning out, and hence I would say that we have a certain proportion in GSEC allocation. If you look at the portfolio that we have, which is benchmarked to Nifty, so we have I think 7.4% is where we have invested in 10 years. Just to say that if I look at 1 year down the line or 1.5 year down the line, that might actually outperform going forward, because we have a certain view on banking sector as well. So my sense is that a certain amount of portfolio allocation towards GSEC is important. Equity is predominant portion, but here we are very focused on sectors and where the resilience and volatility in earnings are going to be lesser.
Did I um, did I read that you are slightly less sanguine on banks, CVs, etc., because the capex drive may not be
Yes.
as strong as the street imagines
Yes.
it to be?
Yes. So I think the what you see is a dichotomy. We have discussed this earlier, that you have a fairly steep fall in operating profits of non-finance companies, and the interest costs have been going up roughly about 30-40% on a year-on-year basis. On a sequential basis, this quarter we have seen about 11% rise. So that's eating up into the profits. So the profits are actually contracting. So the profits are actually contracting. So on that's one side of it. The other side of the story is that because of the rising interest cost, there is a significant rise in earnings for banks. So essentially, banks are feeding into the adverse scenario that the larger economy is actually facing. And we know that if the investment cycle doesn't happen, these two needs to converge. So I think what we are seeing is that because of the fall in profits in absolute terms, sales growth has actually decelerated quite a bit. Many indicators that we're looking at, such as sales in absolute terms, have fallen. Raw material, allocations decrease. So multiple variables, profits, absolute levels have fallen from various peaks that we have seen over the last 4 or 5 quarters across across most sectors. As a result of that, the demand for credit would actually decelerate or decline. So we've seen that from the industrial sector, it's actually fallen to 8% or thereabout. It had recovered a little. We are seeing certain buoyancy as far as metals are concerned. That's where the EBITDA is actually falling more. So essentially, manufacturing sector seeing a fall in operating performance, that pushing them to borrow more for banks, and this is not going to sustain. So as they scale down, the demand for credit would also come down. So that's one part of the banking story. The other part of the banking story is that banks are relying a lot on retail lending now, because the wholesale lending is not really growing anymore. As I said, the non-finance companies are not really requiring that kind of working capital now, and they don't have too much of appetite for investments because profits are contracting. So basically, banks are relying a lot on retail lending, where the competition is very high. Then we looked at the compensation growth of the formal sector, which is the corporate sector. If you look at uh, sectors outside of IT and the banking sector, the growth in compensation is just about 3 or 4% on a 3 year CAGR basis. But the lending growth is growing at 20%. So on the retail side, So essentially, that is a scenario that can create quality issues later on. So my sense is that your spreads would actually come under pressure because your cost of funds is rising. Demand for fund from corporate may actually be decelerating, and eventually, I would say next year you might actually see retail lending also slowing. So and all these things will create increase in or a bottoming out of the NPA cycle. So I think because of that, the outperformance that we've seen, the valuation expansion that we've seen, that could be at risk. So if you look at this year to date, the bank nifty and the PSU banks have actually seen a significant contraction in terms of the price performance. So that is the thing that we're looking at. So we are looking at a sort of a convergence of cycle. This whole discordance of cycles may not really sustain. It's a short-lived episodic divergence, which will eventually converge. And we have studied this for the last 30 years. It doesn't really diverge for a long time. So that is one. I think on the capex side, we are furthermore convinced that yeah, you have good amount of investments happening in digital space and in smart technology, etc. Export-led companies have done well, but if you look at the core manufacturing sector, investments are actually lagged. And with the corporate performance that we are seeing, where you have 3 quarters of declining profits, the ROEs may actually be falling as a result of that, and then the interest costs are rising. The incentive for companies to sort of invest might actually be waning. And I think the volatility in sales, if you look at the sales growth, it rose to almost like 50% in first quarter, then it was 30% in second quarter, it was 16% in third quarter. This is talking about non-finance companies. And I think it will come down furthermore to almost like 8% or so in the fourth quarter. It might become negative or zero in June quarter next year,
Wow.
next
So,
financial year. So I
so
think,
Dhananjay, sorry, please. No, I'm just trying to think. In which case, I presume that your view on the index at large should be
yes.
negative and should be the ideal levels, according to you, should be lower than where we are currently.
Yeah, so the range that we have given is something like 16,500 or something, and 18,100 at the upper end. But the bias is more towards the downside, given the earnings that we are looking at. And so the joker in the pack is the multiple. So the multiple, if you look at the multiples for the Indian markets on a 1 year forward basis, in my report, I've shown that that Nifty and Sensex are roughly about 45 to 55% versus the global average of about 14.7%. Prior to COVID, if you look at 5 year average, the global average was 20 times, and India was marginally above that, maybe 22 levels. So the valuation differential is significantly high, and the expectations on earnings are very high. I would say it's very optimistic still. People are expecting 25% growth in FY24, and I would 23 is still about 12 to 13%. So the asking rate for the fourth quarter is going to be significant because we have seen significant contraction in profit in the first 3 quarters. So I would say that you have all these things. So the valuation is something that it's very difficult to sort of guess. But I see there is a significant gap, and I think the uncertainty index, the risk off index, I track the VIX index. I mean, that's fairly low at this juncture. So I think the risk appetite in the market in general is still fairly high, I would say. So I think there are three, in the tripod we have three legs. So two, with respect to the earnings, I'm confident. Valuations are on a higher side. The uncertainty parameter, or the risk off parameter, is something that keeps wavering. But I think if we follow the earnings trajectory and the fact that you will have a higher rates for longer, I think the bias on the valuation is on the downside than upside.
Got it. Dhananjay, one final question due to paucity of time, but
Yeah.
it's a thought that I picked up from a conversation with Sonal Verma of Nomura,
Right.
and that there is a possibility that she believes, and you look at the economy very closely, would love to know
Right.
your thought as well, that the
Right.
rural income or the rural
Yes.
spend may actually not be the problem, but the urban might be. And therefore, I want to correlate the equity angle to it. Rural focused plays have largely been shunned for the last 6, 12, 18 months.
Hmm.
Do you think that 2023 portfolios could get realigned to have a lot more rural focused plays, maybe staples,
Yes.
maybe FMCG, what have you?
Yes.
Do you think that is a
Yes.
possibility?
Yes. So my portfolio is already aligned towards that. So, a lot of FMCG names are there in my portfolio. I have autos, which has been overweight. I think the big thing that we would want to sort of play is sort of margin expansion theme. Basically, if the slowdown happens, you might actually, as companies to work towards descaling and economizing their operations, they might actually, there are certain companies who will be having an edge as far as margin protection is concerned. So I think many of these names are consumption led. Now, coming to the rural urban thing, I would say that the entire a significant portion of the recovery in India is largely led by the corporate sector, and especially the cyclical sectors, the export led sectors which benefited from global bounties. And then you had metal sector which saw significant rise in EBITDA and the hiring that was happening. Likewise, banking sector also saw significant traction. So these are certain sectors, but generally, I would say that there was a sort of a buoyancy in the urban recovery because of the betterment of corporate performance. So that was the story till now. What we are seeing is that profits in the corporate sector is actually contracting in absolute terms. As a result of that, some of these urban plays might actually start waning. Going forward on the rural side, what we are looking at, you can segment this into agriculture and non-agriculture. I would say that government has actually been scaling down allocation for rural, especially with respect to the food subsidy and other subsidy. They have done massive cutbacks, and also under Manrega. So I think as far as government commitment from the budget standpoint is concerned, it looks to be descaling allocation on the rural areas, while they're still fairly robust on capex, which I doubt will happen because as corporate tax doesn't happen, the buoyancy in taxation will not happen, and as a result of that, government will not be able to do that capex that they have actually budgeted for. What will I guess what is also happening is the agriculture sector. There is a sort of a increase in consumption for agriculture produce. So, for instance, you have the
Sorry, we lost Dhananjay Sinha, but we got the gist of the conversation with him. Doesn't seem to be very pretty picture from an equity watcher's perspective or an economy watcher's perspective. But let's see if indeed India Inc. manages to withstand the earnings downgrade picture and and do well, that it might just do the trick. Dhananjay Sinha mentioned that his portfolio is already aligned a lot more towards the rural side as well. They are not as overweight financials as the street might be, and his fair range for the index is 16,500 to 18,100, because it's very difficult, according to him, to pinpoint what multiples the market would trade at. Thanks for tuning into this edition of the Talking Point, and have a great weekend.